December 31st, 2025. If you traded gold today, there is a high chance you were not competing with the market. You were being processed by it. This was not a day of trends. This was not a day of reversals. This was a day designed to exhaust traders. From 7 a.m. to 2:44 p.m., the market did not explode. It did not collapse. It continued. And in that continuation, capital disappeared quietly. Main body. At the open, the chart looked calm. Small rebounds. Clean price levels. Enough structure to invite participation. This was not strength. This was permission. Permission for traders to believe. This day was tradable. The pattern repeated. A rebound. A sharp downward spike. Another rebound. Another spike. Again. And again. No continuation. No confirmation. Only fatigue. Every new low looked reasonable. Not dramatic. Not shocking. Reasonable lows are the most dangerous. They do not scare traders away. They invite them back. By midday, behavior changed. Most participants were no longer trading setups. They were trading recovery. Losses had already occurred. Now came the need to fix them. The market recognizes this instantly. This is where damage accelerates. This market was not violent. It was patient. It allowed hope to form. Then it removed it. Slowly. Methodically. By the time traders realized they were being cut repeatedly, the day was already advanced. Capital was damaged. Emotions were compromised. The chart remained active. The traders were already weakened. Decision to stop. This is where I stopped. Not because the market was unclear, but because it was too clear. This environment did not belong to me. Anyone adding funds at this stage was not early. They were late. Late to a process that had already begun. If you watch this entire video, ask yourself one question. Were you trading the market? Or were you trading hope? If you have experienced a day like this, leave a comment and write, "I survived." And if you are still learning when not to trade, subscribe. The market will always be here. Your capital must survive first.